Joined by Philippe Gijsels from BNP Paribas Fortis Global Markets. Thank you so much for taking the time to speak to us. So, as we go into the second half of the year, I want to ask you about how you expect this issue of mounting budget deficits, government debt in Europe and the US to impact on global financial markets.
Well, it will certainly create some more volatility. So we were already penciling in a slowdown in the second half anyway. The inventory correction would come to an end. The positive impact of tax measures would end. But on top of that now today we have the fiscal consolidation, and at the moment it's anybody's guess how big this impact will be, and our case-based scenario at the moment is for a serious slowdown but not a double dip. But of course you have an alternative scenario in which it slows down more than we think, and then you would have a double dip, would be very negative for earnings. So now you see earnings estimates already coming down a bit, but I guess this trend will continue somewhere in the second half.
So will cutbacks in spending, austerity measures taken by some European nations restore confidence in stock and bond markets?
Well, I think it's the first good step in the right direction. It's clear that fiscal consolidation is probably necessary. The debt levels are way too high in many countries. So in the long run, this is clearly a positive. Of course, you will have the negative impact. In the first run, you were talking about Greece before. So you have social unrest in certain countries. It's not hard to imagine how you can get in a negative spiral, because also for the tourist industry, and also because the economy goes down first, your tax revenues decline, you have more debt, you have to take more austerity measures, so you have a vicious circle that you have to break. And what we maybe would like to see more is maybe monetary easiness, maybe some quantitative easing to cushion more.
So could fiscal consolidation then bring about a slowdown in economic growth, if not a double dip?
Well, that's certainly a possibility. If you already were looking at an economy that was going to slow in the second half, and on top of that you have this fiscal consolidation, which is certainly going to hurt growth, at least in the short run. And it's also a little bit of uncharted territory, because you have many countries at the same time doing the same thing. So this is a bit unprecedented in history, and then, like I said, it's anybody's guess how big the impact will be, but it's clear that there will be an impact on the economy if you cut spending and increase taxes. Your economy will slow.
Nobel Prize-winning economist Paul Krugman has said that deflation is possible within the next few years. Where do you stand on that?
Well, in the short run, that's certainly a very big risk, because if you look at Ireland, which went before many other countries in tightening the budget and so on, you see that they're already clearly in deflationary territory, and you also see that the number of the southern countries in Europe, you see inflation levels coming down as well. So deflation is clearly a risk to this slowdown. In the longer run, inflation may be a problem, but in the short run, I guess deflation is the big enemy.
Now, if we could just move across the Atlantic to the US, the Federal Reserve has said that underlying inflation has trended lower. Employment numbers are not improving quickly enough. Consumer spending is weak, and US housing is doing badly as well. What does all this tell us?
Well, this tells us that in the West, contrary to the East, where growth is strong and inflation is the risk, in the West that the economies are slowing. We don't know how much, that we will have to see in the second half of the year, but it's slowing, and deflation is the enemy. And for stock markets, this means that everybody is asking themselves the same question: how much or how strong will the slowdown be in the second half? And the problem is that markets will not know until the end of the year, because we need these figures for the third quarter and the fourth quarter, which we don't have. So this means that for the stock market, that we will remain in a period of high uncertainty and high volatility.
Philippe Gijsels, thanks very much indeed for sharing your outlook, your thoughts. We appreciate it.